Hey guys, how's it going everyone? In this video, we're going to be going through how to read and understand the balance sheets. Of course, by using a real case example. Well, I'm a financial accountant and I actually work in a process of creation of those balance sheets, profit and loss statement, financial statements, and so on and so forth. So today, I'd like to provide step-by-step explanation how it works as well as where all numbers are coming from in there. So also for people who already have some kind of understanding or who are at a certain level, I'll also try to bring some additional value for you guys. I hope I will. By the way, let me just quickly remind you before we jump into the topic of balance sheet to subscribe for the channel, as in the future I'm going to be more talking about finance, investing, money, no money, no honey, by the way. Just kidding. So let's just quickly remind ourselves what is balance sheet, and then we're going to get to the balance sheet of Apple company as an example. So the balance sheet is one of the three main reports of financial statement, which by the way goes to the public afterwards. Basically, the purpose of balance sheet is to show a company's financial health. Balance sheet provides us with information about assets of a company, meaning what company owns at this period of time, as well as liabilities, meaning how much debt you have, and shareholders' equity, which means that in a very simplified way, how much the owners of a business invested into the business, or how much is actually the shareholders' part out of everything what company has. So as an example, I will be using Apple company's balance sheet. I have already showed how to get to financial reports. Let me do it once more. So we write in Google Apple Investor Relations, then we click on the very first website popping up, then I go to SEC filings, which is Security Exchange Commission filings, and already here I can start sorting out for annual reports of 2020. As for 2021, the report did not come up yet. So now we are on the annual report of 10K. Here, in the content, we need to choose financial statements and supplementary data. And then we choose consolidated balance sheet. Well, yeah, please do not get afraid or get scared of the word consolidated. Again, it is still the same, balance sheet. Just the word consolidated means that they have collected, all the Apple's, local office balance sheet and actually converted into one big, document, which is now called consolidated balance sheet. So it's basically bringing all the reports into one report, so it's easier for us to take a look what's going on with the company. So before we start taking and analyzing each components, it's very important to mention a few things. So the first thing is the amounts. As you can see, for example, cash and cash equivalents are $38,000 for 2020. However, it's written here at the top in millions. So that means that we would need to add 6 zeros to our 38,000, and the amount of cash and cash equivalents that Apple has is actually $38 billion, which is huge. Imagining just cash and cash equivalents itself has that amount of money, it is just very powerful. So the second thing to mention is, as you can see, the major components such as assets and liabilities are divided into two groups, current asset and non-current asset, and as well as current liabilities and non-current liabilities. So the reason why we have it that way is because the word this current means that we can expect to convert our current asset within 1 year, and the same with current liabilities, that it can be paid to our creditors within also 12 months. And then obviously non-current assets and liabilities are for more than a year. So, and the very last thing to mention before we go is actually the main equation of the balance sheet, which is asset equals to liability plus equity. So as an example of Apple, we can see that our total asset is 323 billion. So the same as we have for liability plus equity, 323 billion. So the first line item we're going to be talking about is cash and cash equivalents. And so this is the most liquid asset line on the balance sheet? Well, first of all the bills, coins, currency notes, the money on the bank account, money on the corporate, demand deposit account, all those things go to cash component. Whereas cash equivalents is the short-term investments which are possible to transfer into cash within 3 months with a very low risk. So those could be treasury bills, short-term government bonds, certificate of deposit, and some also marketable securities. So if company needs for example urgently some cash, they can rely on those papers to be sold for cash inside 3 months. This is a very normal practice when companies have lots of cash for rainy day, or they have cash but right now they don't plan to spend them right away because they're planning to buy some equipment or acquire some new company, and they need some time to analyze things. So in order to avoid the situation where money just lying on the bank account and does not work for you, they could invest in such short-term investments with low risk and low profit. That's actually better than nothing. Talking about the marketable securities, big companies, they also do buy some stocks, bonds, and they do some other investments like us. So Apple has their marketable securities separated from cash equivalents. It's mainly because it's possible to convert into a cash not in 3 months but more than that. So that's the reason why we see those particular marketable securities separated from cash equivalents. Getting to accounts receivable net. Well, first of all, the accounts receivable itself is the customers which have not paid us yet for the all the products or services which we have sold to them. So it's basically they owe the money to us. And the reason why we have it as net receivables is because some of our customers could be in the process of bankruptcy, or they are having some liquidity problems, which means to us that there is a high probability that they will not pay to us. So here we have to take away those bad debts and actually show the real number or real amounts of money for our investors to present the fair balance sheet. Getting to inventories, it is actually the products that we sell to our customers, basically the main purpose or the main products of our business. However, inventories could be divided into 3 categories. First one is raw materials, the second one is raw materials in progress, and the third one is finished goods. For example, it's not the best example, but still, if we take Tesla company, and let's say if I'm buying a plastic from another company for my car, this will be called as a raw material. If I already have put the plastic with the mirror together and it is already headlight, this could be raw material in progress. And once we have our car ready to sell, it is already finished good. So when we are summing up all those 3 categories, we have a line item called inventories. The next thing we have is vendor non-trade receivable. Well, this is something very, very specific as a name, only for Apple company. Well, after going through explanation of this item, it's basically almost the same like a prepaid expense. So let me just a little bit talk about the prepaid expense. So in accounting, we have such phenomenon as accrual basis accounting. So let me give you an example. Let's say you bought an insurance package for 2 years, and usually you paid beforehand, right? Which actually means that this insurance company will be providing you with an insurance service for following, let's say, 2 years, which means that I have now a non-material asset for following 2 years to be provided by the insurance company. So that is called actually prepaid expense. But so in case of Apple, they have already prepaid for outsourcing companies to deliver or to provide some of the components for their phone or for their iPhone in the future. So that's basically prepaid expense, or in this case, that's a vendor non-trade receivable item. Also, the last thing in current assets, we have other current assets, which are, the small assets accumulated together under one item, but as standing alone, they would not make big impact on the balance sheet itself. By the way, I'm going to be going through the particular each small assets inside, other current assets in my other videos. So do not forget to subscribe for the channel. So here we have another marketable securities, and the difference between the one up here and the one under non current asset is that they're convertible to cash into more than 12 months. So for example, they could get some bonds which could have the duration for 5 years, 10 years, and something like that. So the next thing we have is property, plant, and equipment, which is also called as a fixed asset, meaning they are physical assets that company cannot easily liquidate. Those can be the offices the company owns, equipments, different types of cars, vehicles, computers, lands, buildings, and so on and so on. So getting to liability sections, before getting there, let me just quickly explain you something. So we have here current liabilities and long-term liabilities, and sometimes the same debt can be on the both sides, in the current one and in the long one. For example, let me just go through an example. You should if you take $12,000 of loans from bank for 12 years, let's say, you have to be making $1,000 paying back, let's say, each year. So the first $1,000 that you have to be paying will be obviously on the current liabilities, and the rest will be on long-term liabilities. So that's how it is. But actually, even though they are located in different positions, that's actually the same debt. So we've got here accounts payable. Those are the short-term debts that we need to pay for our employees, vendors, suppliers, and so on and so on. The next thing that we have is other current liabilities. Well, other current liabilities could be accruals, deferred tax. Those are actually the topics which I will also make a soon video about them, and it's gonna take some time, and that's the reason why I'm gonna dedicate a special video for those topics. So further, we have deferred revenue, or it's also called unearned revenue. It is amounts of money that we receive from our customer for our products or services. However, they have sent those money beforehand, and we actually have not yet delivered the good or provide the service to them. So there is it's kind of not yet earned the money that we have. So until we do our obligations, we have the money parked as a deferred revenue. But once we do the job, then it will smoothly go to the revenue part on the profit and loss side. Also, talking about the commercial debts, is a financial short-term instrument. Well, in other words, is a debt document that covers short-term expenses such as payroll, payables, and etc. So here we have the term debt on current and non-current side. And this is basically what I have been mentioning, and other long-term debts. Commitment and contingency. Sometimes there is no amount, sometimes there is. In our case, there is no amount. And the reason is because it depends on the probability. So just to explain what do I mean by that. So I'm going to give a very short example. Imagine if someone, for some reason, decided to, file a suit or bring a claim to the court against us, and the result of this claim is not yet known. However, if there is a high probability that our side is actually guilty and we will have to pay approximate amount of or measurable amount of penalty, then we will show the amount on the balance sheet. If there is a really low probability then that we lose the case, then we just disclose it on the notes of financial statements with the details. Shareholders' equity is actually the representation of shareholders' piece or shareholders' stake. So, well, first of all, let's understand, all of those, written things here. So, as you can see, it's written here common stock. Well, just in general, we have, preferred stocks and common stocks. So, in case of Apple, we don't have here any preferred stocks. So, basically, just quickly to remind you that if in preferred stocks you have a higher claim to dividend, so you get it first. And also, if company, for example, goes to bankruptcy, and while distributing the asset to the shareholders, so the first guys on the list is actually the guys who hold the preferred stocks. However, in preferred stocks you have no rights for voting and making any impact on company's operation, whereas that's the case for common stocks. When you have a common stocks, you actually have all the rights to make impact on the company and make some votings and hire actually the director, CEO, and so on and so on. So let's talk a little bit about the shareholders authorized and shareholders issued here. So what does that mean? So authorized shares are actually the maximum number of shares a company is allowed to issue to investors, whereas outstanding shares are actual shares which was issued or sold to investors from available numbers of authorized shares. So that's basically what it is about. And the next thing we've got here is retained earning. Well, first of all, let's just understand what is retained earning in general. So as you already guys know, we've got profit and loss statement and balance sheet. The balance sheet, the one we are looking right now, and we have the other statement, profit and loss statement. And in the profit and loss statement, the way it works, we have revenue, expenses, and after that we have a profit or net income. So usually the companies decide to pay some part of their profit to their shareholders, to their investors as a dividend. Then everything what's left can be reinvested to the business back. So that reinvestment money is called retained earnings. So the process, the way how usually it works is that once they have selected the percentage that will go as a dividend for investors, then everything what's left, the percentage or the amount of money will go for the retained earning for the business, for maybe some new projects to grow the business or expand the business. So that was basically it, and the rest of the thing that we have left here is accumulated other comprehensive income. Well, in a very soon I'm going to be making like separated video about other comprehensive income, what it is, how important it is, and what kind of impact it would make for investors. So that's the reason why guys, please do not forget to subscribe for the channel, and thank you very much for your time, and stay healthy. Have a good one.